Hello, welcome. My name is Karen. We're going to be going through a series of workshops that talk about just understanding how money works and just some money management in general. As you know, a lot of people have gone through some difficult times. Stress is over the top sometimes, especially in the area of finances. So I pray that as you listen to this information, you will be able to take away something, and may God give you the wisdom and understanding to make some differences in your life. So stay tuned as the workshop starts. Thank you so much. I'm here to give you another workshop. This one is on life insurance. And so when we look at life insurance, we realize it has many purposes. As you can see from the picture on the screen, it helps people in difficult times. It gives you a sense of security, safety, coverage, protection, and some confidence to know that you're going to be okay. So we're going to delve into that a little bit today. But let's first start off with a scripture reading. So Genesis 41:36 says, "This food should be held in reserve for the country, to be used during 7 years of famine that will come upon Egypt, so that the country may not be ruined by famine." And then Genesis 41:54 says, "And the 7 years of famine began, just as Joseph said. There was famine in all the lands, but in all the whole land of Egypt there was food." And so when you think of, the Old Testament and olden day times, and you look at current day times, obviously we live in totally different worlds, but they use their preserves as an old-fashioned type of insurance to make sure that if something bad happened, they would be okay. And so in modern day times, we have insurance to be able to provide us with that protection for our family, for our loved ones, so on. So let's continue on. So we basically have three phases of life that we need to be aware of, right? So obviously, we can die too soon. The solution to that is making sure that you have life insurance, something to cover some final expenses. And of course, it's important to also have estate planning. These are some of the topics we can delve into at a later date with more detail. The second is we get sick or injured too soon. We didn't plan for that. So the solution is more like a living benefit. So the solution in number one is really, you being able to leave something for the generations. The second one is you receiving something while you're ill that helps pay your bills, like critical illness or disability, or maybe you can use that money for treatment somewhere. So that's a topic for another day. And of course, the third is you live too long. So grandma there's, or great grandma, she's 100 years old. And so she lives a long time. And are we prepared for that? So the solution is retirement planning, retirement income streams. These are important to make sure that we're planning for these things. So what we're going to focus on today is number one. So here's some reasons people don't own life insurance. They have other financial priorities. It's too expensive. They don't feel they need any. They're unsure of what type to buy. They haven't got around to it. They obviously think they're invincible and they're likely not going to die. So this is some of the reasons why people don't choose it. My personal experience with people is it's on their mind, but they haven't gotten around to it. Now you're going to find people that fall into these other categories, but it's really a myth that it's too expensive. You can always find something to be able to set aside for those needs. So this was a 2020 study by LIMRA, which basically tracks all the stats in the life insurance industry. So if we take a look at life insurance and the impact it has, right? And why we need it. When we're young, we're not thinking about, planning for the future. But, once you're 18, you start to, let's say, work, get a job, meet a significant other. Now your needs change, your vision changes. And so in the early stages of that life, you're generally less financially secure. If you've purchased a home, you'll have higher liabilities and smaller assets. But the theory of decreasing responsibility really means that as you focus on moving towards your retirement, you're building wealth, which is this blue curve. And then, of course, as time goes by, your responsibilities should diminish as you get older. But the challenge we have in our world today is it hasn't really worked like that. So generally, it should be as we're older, we're more financially secure, but because we have greater assets and our liabilities have decreased. So there's a number of reasons why people would require the need for life insurance. So sometimes it's to pay out an outstanding debt in the event something happens to you, or to replace the income that was coming into the household for the breadwinner, or to pay off a mortgage balance, or to secure other assets you might own, setting aside some money for your children's education if you pass away early. And then, of course, replacing the retirement income that you would have provided to your spouse. And then lastly is to leave something for the next generation and have proper estate planning. So a number of reasons that maybe most people don't realize. So when we look at what's happening out there, there's a lot of GoFundMes. In fact, 544,000 accounts in 2018 that had the word funeral in it. Now, that just goes to show you that people either A, are not educated about the need, maybe procrastinate about it, or just choose not to have it, and then that burden becomes their families. So if we look at a more recent stat, which the bottom line I just pulled off of GoFundMe site, and it just talks about right now it's about 330 million per year they raise for memorial reasons. So that's 125,000 GoFundMe accounts just for the purpose of funerals. So if you planned ahead, you wouldn't leave that burden to the ones who have to go create a FundMe account. So Galatians 6:5 says, "For every man shall bear his own burden." Proverbs 13:22 says, "A good person leaves an inheritance for their children's children, but a sinner's wealth is stored up for the righteous." And 1 Timothy 5:8 says, "But if anyone does not provide for his relatives, and especially for family members of his household, he is denied the faith and is worse than an unbeliever." So sometimes we can be so consumed with our own needs, our own personal place where we're at in life, and we often don't think about these crucial things that we need to plan for. So I have a question for you. Let's say you're a young family and you've got young kids at home and you're blessed with the ability to have a stay-at-home parent. And then the main breadwinner passes away. If there's no life insurance, that family will most likely have to move to a cheaper neighborhood, maybe a school that isn't as nice, and the mom or the remaining parent would have to go back to work or start working in order to provide. So think about this. Because you don't make that decision to protect your family, now your kids have to move out of the home they've always known. Their friends are, let's say, now totally different because they're in a different school system. And instead of having one parent home to grieve and take care of the hurts of a loss of a parent, now they're having to, suffer on their own in daycare, in school, because mom or dad is working long hours to provide for income. So these are things we need to think about. It's not really about us. It's about the people we leave behind. So if we take a look at having a proper financial foundation, we want to talk about the strength of a proper financial foundation. Now, most people think about, oh, I need to plan for retirement, but really, I'm going to work this backwards. In some of the other videos, you'll see me work it from the bottom up, but I'm going to work this backwards for a reason. So let's say you focus just on retirement, right? And let's say, something happens, a catastrophic event, and you didn't have emergency fund. If you didn't have an emergency fund, now you're dipping into that retirement Think of COVID. What happened during that time? A lot of people didn't have emergency funds or a very small amount. And when they lost jobs or, unforeseen things happen, now they can't work because they're taking care of their sick parents or their kids at home, homeschooling, whatever, and it's just too much. Now you've dipped into your retirement pot. Now, let's focus on the emergency fund. Let's say you didn't plan for an emergency fund, right? Okay, well, what happens if a catastrophic event happens? Now you've gone into debt instead of having that reserve on hand, right? So that now becomes a problem because now you're managing the debt and you have that added stress. Now let's focus on this debt. If you don't manage your debt, the things that require you to protect your family, you may not choose to set aside those dollars for proper protection because you're now focused on paying off your debt. So without proper protection, this whole financial foundation will collapse. Let me explain that. If you have enough money on reserve, right, your family will not have to go into debt for an illness or an untimely death. And they will have enough money to be able to pay for the funeral costs, which means they don't need to tap into that emergency pot and it won't affect their retirement. So building a proper financial foundation from the ground up is important. Think about it from the perspective of building a house. You never start with the roof, you start with the strong foundation. If you think about it from a biblical standard, everything is on a firm foundation. So there are two basic types of life insurance. So if you take a look at what most people are familiar with, it's term insurance, which really is temporary type of insurance. And then you have universal life insurance or a permanent type of insurance. So I'm going to explain the differences between the two as I go along. But let's calculate how much you actually need. Now, the easiest way to remember this once the video is done, think of the coin, the dime, D-I-M-E. So the D stands for debts outside the mortgage. So let's say hypothetically somebody had $60,000 of debt outside the mortgage. Now that might seem like a lot, but a lot of people carry credit card balances, have lines of credit, and then sometimes two people working in a household will have two vehicle payments. So if you think about the balances that may be due on one vehicle, it's usually about $30,000. So if two vehicles, it's $60,000. So let's just say with vehicle debt and credit card lines of credit, the average family actually has about $35,000 of debt. And if you look at Canadian stats, they say $23,000 for every man, woman, and child. Now, we know children don't have debt, so per head, there's $23,000. So lots of people have large amounts of debt. Lots of people have small amounts of debt. So this is just an average. And if you want to learn more about that, you can always research online here to find out the debt management or cash flow management workshop, which will give you some help in that area. And then, of course, we have to talk about income replacement. So the easiest way to calculate that is, you take a person's take-home pay, let's say it's $4,000, times that by 12, times that by 10. Now, why 10? Well, 10 would be like if you have teenagers, they're going to go to school and they're going to be with you for the next 10 years, it should be 10. If you have infants and they're going to be with you for the next 25 years, minimum that factor should be 20, not 10. So when you calculate it just with 10, that means you need 480,000. Now, income replacement is two things. It will provide a chunk of money that you can then invest and draw an income to replace what your spouse was contributing to the household. That's one reason. But then after the family is stable, the bereavement is done and you're moving on with that next phase. Maybe your kids are in school now and you're going to work full time. That remaining balance can then be put aside for your retirement and allow that money to compound, which really replaces the income that you would have contributed to the retirement pot over time. So that lump sum will allow that family to retire with some dignity. And then, of course, your mortgage balance. The average house in Alberta here is, between 400,000 and 500,000. If you look at other places in Canada, in the US, in the world, the prices will fluctuate. So whatever your balance might be. And then when you look at education costs, let's say a couple of kids, 60,000 per child for their university costs for books and tuition while they're living at home. If they're away and, they're going to school in another country, that's a whole other amount that you need to calculate. So you add this all together, and just to calculate one person's income needs, it would be $1 million, over $1 million of coverage. Now, let's say you have a stay-at-home mom. How would you calculate that? All these factors would be the same: 60, 400, the 120, that'd all be the same. What would be different is the income replacement. So how I would calculate it is I would say, okay, well, what would a full-time nanny cost living at home with you? $2,000 a month. Then, obviously you need to factor that in, because you still have to somehow pay for childcare if your stay-at-home parent is no longer there. So if we take a look at term insurance, most term insurance will be there for a period of time. 10, 20, 30 years are the typical amounts. You pay for that term period, your premiums remain the same. So think of it like a step or a set of stairs. For this first period, let's say your 20-year period, your premium doesn't change, but then your premium will definitely increase. So most insurance today, term insurance, is what we call renewable and convertible, meaning you can convert it to a permanent policy or you can renew it. Now, we have to also look at the fact that if you renew it for that next 20-year period, renewing it means you don't have to prove evidence of insurability, which means the insurance company will automatically give you another 20-year term. But this can be very expensive, because insurance companies also know that the people who renew versus apply for new coverage, the people that are renewing are probably having some type of illness, or they've been given a terminal notice or whatever, or they're just uninsurable. So they will charge you 4, 5, sometimes depending on if you've had a medical rating before, maybe up to 10 times what it was costing you per month. So if you do have a term and you're at close to your term period and it's coming up, let's say, to your 19th year, it's a good idea to plan ahead. If you're in good health, you reapply for a new term coverage, and that is much, much cheaper than taking a renewal. Or your alternative then is converting it over to a permanent policy. But as you'll see in a later slide, there are some advantages and disadvantages to both. So when we will look at this, we say, it's inexpensive. Term is the most inexpensive type of insurance to get, but you have to weigh whether it's right for you, and that's the best option. So here we compare the two. When we look at term insurance, it costs less. People like that, but it is expensive to renew. So you're 20 years older, you get a new policy, it's naturally going to cost you more, right? The closer we are to God, the more things cost as we get older. If you take the renewal, it's very, very expensive. And then you also have to look at the factor that, if you're 75 and 80, a lot of insurance companies won't even give coverage to you in those later years. It's like renting versus owning, right? So if you rent an apartment, your money's going nowhere, versus if you own a home, it's creating equity or savings, right? So there's no cash back in a term policy, but it does give you peace of mind. So in the early years, when you think about that theory of decreasing responsibility that I talked about, sometimes term insurance is the best option, right? You don't have a lot of savings to contribute to a permanent policy. It's cheap and it gives you peace of mind, protects your family. When you look at term insurance, the advantages for term insurance often for a lot of people will outweigh the disadvantage of that first X you see, the more money upfront you have to pay. So because you can have term insurance for your entire, or excuse me, let me repeat that, because you can have permanent insurance for your entire life, it will cost you more upfront for the cost of insurance versus over here with term insurance. And it can give you some tax breaks. That's another class for another time to explain that in detail, although I will touch on it a little bit at the end. And then it can give you some money back. And you have the ability to create some savings. So it's more like creating equity inside that policy or cash inside that policy. And then it does offer you peace of mind. Now, if you were to make the decision not related to budget, but what would be better for you, I think for a lot of people, they would see, oh, this makes sense. I can get something back. I can even get a return on my premium if you think about it from that perspective over the course of your life. Whereas this one, maybe not so. But if you want to take advantages of both, you can actually set up policies today with a little bit of permanent coverage and a big rider of term insurance to cover for short-term needs. And then the little bit of permanent coverage can be for the later needs and some cash accumulation. If you look at the statistics of our wealthy people in the country, 95% of people are retiring broke in our country here in Canada. United States is about the same. In other places in the world, I'm not familiar with your statistics. However, when you look at the 5% that are retiring financially okay, they understand that when you have permanent insurance, it's a place where you can accumulate wealth tax efficiently. So we take a look at whole life. So one of the things that whole life does is it'll take the cost of insurance and average it out over your whole entire life. So if you're 30 and they run it all the way to age 100, they're going to average that cost. So it is a fixed level premium. You have to make the premium. It doesn't allow for any flexibility. It has low guaranteed rates on the cash value. So you have a guaranteed interest rate that you're earning on your cash. You can access your cash as needed. There are many features inside of a whole life. You can buy more insurance. You can pay it. It can offset your premiums. There's a bunch of features inside of there that you could choose as options. It can pay dividends, and the dividends can cover for the cost of insurance in the later years of your policy. And the cash that's accumulated in there pays out to the beneficiaries tax-free, and there are ways you can get it out tax-free. When you look at universal life, it's kind of a hybrid of the old-fashioned term insurance, the old-fashioned whole life insurance and term insurance. And it does offer more flexibility. So you can see the green chart here, the premiums going up and down. So those are the flexible premiums. So you have a minimum base and you have a maximum, and you can choose to do whatever you want in between there. So you pay the premiums which need to cover the cost of insurance when you're doing the minimum amounts, and anything above that minimum then goes into the pot of money and allows you to save and accumulate cash. It is tied to investment funds, so you can actually get decent rates of return. However, like investments, it goes up and down, so you have to be aware of that. Whereas in the previous example, when you have a fixed interest rate or a guaranteed interest rate, there's no fluctuation on your money. This can also be tax advantaged. You can access some cash as well. With universal life, it has a surrender period. So the first 10 years, there are some fees. If you cash it in, you're going to get less than the cash accumulated in there. It's designed for long-term, not short-term. Whereas if you look at whole life, there is no surrender charges inside a whole life policy, but it doesn't have flexible features either. So you kind of have to weigh out which one makes better sense for you. So if you're funding a universal life plan properly, then the bonuses inside the plan will actually take care of the cost of insurance. Whereas on a whole life, your dividends can take care of the cost of insurance. So things to think about. So here is a way to describe a permanent policy like a universal life, which is more commonly used today than whole life. if you take a look at the insurance industry, it has some great tax advantages. However, historically, some poor rates of return. Insurance companies have been good at insurance, not necessarily the investment side. Now, there are some companies in our particular country that have proven to have some decent rates of return on the guarantees, but you also have to investigate that and do your homework and your research. If you take a look at, let's say, some of the advantages of the investment industry, you're going to pay some tax as your money makes tax, or as your money makes money, sorry. Like, for example, if it's linked to the performance of a mutual fund, inside a mutual fund, you're going to have like capital gains, dividends, interest income. So when we look at the investment industry on the side, as you make money in those areas, you'll pay tax. Now, inside a universal life plan, it has some unique features that make it a bit more tax efficient. So when we look at the insurance industry saying that we don't pay tax, it's because they have their own insurance laws that allow them to be separate, let's say, from laws on our income earning. And so when we go back to this investment side, we say, okay, so we might pay tax on the growth of our money, but we also have opportunity for greater rates of return. Now, if you could kind of put the best of both worlds in place, and let's say somebody's contributing $250 to this plan, just as an example, and then, this is going to be some permanent coverage now. So the advantages that you have on the insurance side is you're not going to pay tax on the money you have in there. Also, if it pays out to your beneficiary, it's tax-free, but you pay for that cost of insurance, right? That permanent coverage. So let's say in this case, I just said, okay, the permanent insurance costs you $51 a month. And let's say now you also have that investment portion linked to professional money managers. So the $199 of the $250 allows your money to grow inside their tax-free. And as long as that circle is around. So think of it like an orange. The peel on the orange is meant to protect the fruit. The fruit is the money that is growing inside their tax advantaged or tax-free. And so the idea being, as long as the peel remains in place, that money is not exposed to government tax. But if you remove the peel, then it will expose that money and you will have to pay tax on it. So there's basically three ways you can get your money out typically. Now, this may change from country to country. The types of products are different. The fine print is different. So please do your research when it comes to that. But if you take a look at, let's say, three ways to get your money out, number one is you can do a direct withdrawal. So you can take money out from that center circle. The moment you pull it out, you just have to be exposed to the tax that you'll pay on the growth of your money, not what you put in, but the growth of it above that. And then, of course, the second would be a policy loan. So the way the insurance companies have worked around that is they basically, it's like you being your own banker. This is how the wealthy have used this type of program to be able to fund some of their ventures. They fund it with a lot of money, and then they borrow their own money and they use it for a purpose. Then they take their profits and they put it back in there, and then another time they'll borrow their money again, right? And then, of course, for a lot of people who have some tax issues in retirement, number three would be a special strategy that allows you to use this to be able to offset some of those tax burdens later in retirement. And that is a class for another day for sure. Anyway, either way, you can take your money out tax-free in retirement. It would be a good way to look at it. So sometimes it requires us to educate ourselves, change the way that maybe we've been taught to think in order to understand, well, why do the wealthy use these types of policies and what are the advantages and disadvantages to them? So just in summary, if you had to look at it from a checkmark perspective, term insurance costs less, gives you a peace of mind. Permanent coverage gives you some tax breaks, money back. Owning versus renting gives you peace of mind. So now it's really, given the choice, which one makes better sense to you. So lastly, I will just close with a couple of scripture verses. Luke 12:24 says, "Consider the ravens. They neither sow nor reap. They have neither storehouse nor barn, and yet God feeds them. How much more value are you than the birds?" And I just want to say that in the Bible, there's over 2,300 verses that have to do with money and finance. In fact, the word whatever, whether it's talents or whatever reference they use in the Bible for money and finance, that word is written more times than the word heaven or hell. So you have to think about it. God wants us to learn about money. God wants us to understand, have some wisdom about it, steward properly what he gives us. And so it's important for you to educate yourself and understand, that we have a responsibility to help God's storehouse, right? So in some of my other workshops, I talk about the importance of tithing, tithe, save for your long term, save for your short term, set aside those responsibilities in 30% of your pay that comes into the household, and then learn to live on that 70%. So you have to learn to be disciplined with your money. And maybe it means you got to fix some debt, and some of those pillars that I talked about, but you need to make sure you protect your family. 1 Timothy 6:18 says, command them to do good, to be rich in good deeds, and to be generous and willing to share. So if you are of the mindset that you want to protect your generations, you want to make the generations to be stronger financially, then having some life insurance coverage that you can leave for your loved ones is probably one of the things that would remove their burdens, remove their stresses. And it's probably one of the most selfless things you could do for your family, or unselfish things, right? So just wanted you to learn a little bit today about the life insurance. There are many, many topics that could be pulled from the life insurance industry, which maybe we can cover at a later date, but I hope you enjoyed the information, and God bless you, and may God, just keep your family safe and look after you and your generations. Have a great day.